Hey, it's Josh Brown. I'm here with Michael Batnick. We are live from the compound, and here we go again. It looks like the yield curve is as close to inverting as we've seen in almost 10 years. We're going to talk about why that might be very significant or why it might not matter at all, and let you decide. Stick around. All right, Mike, this is it. We're about to invert in the yield curve, or we're as close as we've been in a long time. Before we get into some of the things that we think about this topic, just for the general audience, what's the best way to describe the inversion of the yield curve and why people believe so strongly that it's an important signal about either the stock market, the economy, or both?
A normal shaped yield curve, and we're talking about the yield curve, you could lend money at different points in time, anything from overnight all the way out to 30 years.
The government lends money at the short term, so a 2-year treasury bond, or the longer term or intermediate term, a 10-year treasury bond.
Right.
And so looking at the difference between the cost of the government's borrowing.
Can I move my hands yet?
Yes, you can move your
All
hands.
right, so normally the short end is here and the longer end is up here, and it goes something like this.
So borrowing money on the long term costs more.
Yeah, as it should. If you're going to lock up your money for a longer period of time, you should get more compensation. Now, when the curve starts to flatten out, either because the Fed is raising rates at the short end or longer rates are declining, eventually, when it costs more to borrow at the short end than it does the long end, that's called an inversion.
Right. Now, the yield curve inversion sends a signal from the marketplace to people watching the economy, and it says the only reason why it now costs more for the government to borrow short-term than long-term is because the market now has lower growth expectations in the future, meaning the people in the market are more pessimistic about the outlook for the economy longer term. Would you say that's the best way to explain it?
I wasn't listening.
Okay.
But if we look at
we're going to stick with that.
Just what the data shows,
Yeah.
the last 9 times the curve inverted, a recession followed.
Right. Within a year to a year and a half,
So
typically.
the average time is 14 months. And of course, the average, it could be, it was as long as 24 months in advance or as short as 8 months. But every single time that there was an inversion in the yield curve, a recession followed.
So the signal is like 10 for 10 or whatever it is. What'd you say, 9 for 9?
9 for 9, going back
9
to
for 9,
1957.
Okay. So for the last 60 years, anytime you've had a yield curve inversion, within an average of 14 months, the economy has soon followed into an actual recession or worse.
And on average, an inversion led the market peak by 8 months. And again, sometimes the market peaked prior, sometimes it peaked as much as 21 months after.
These are averages, so they could be a little bit all over the place.
Right, so like the first yield curve inversion in the GFC came in January 2006. The market didn't top until October 2007.
Okay, so if we see a yield curve inversion this week, it doesn't mean the recession starts tomorrow. The recession could be in almost 2 years from now.
Let me ask you this. Do you think that it's like a law that an inversion will lead to a recession?
So something that's 9 for 9 over 60 years, it's really hard to argue with. However, there are some important caveats, and I think you, in your blog, The Irrelevant Investor, and our colleague Ben Carlson on A Wealth of Common Sense have both done really good pieces in the last 6 months that list what those caveats are.
Well, here's one, and this is from Charlie Bilello. So the average 10-year during the last 9 inversions was 6.1%.
That's the average that the 10-year Treasury bond was yielding
When short-term
during the
rates-
time the inversion happened.
Right. So obviously, this is a lot different when the 10-year is at 3%.
Yeah, could you imagine borrowing 2-year money and agreeing to an interest rate of over 6% right now? It's like unthinkable.
Right.
Okay. So when was the last time that actually happened?
The last time what actually happened?
2007.
Oh, yeah.
Right.
Well, the last inversion happened on January 2006. But the obvious implications are now that like the Federal Reserve is so aware of this and every market participant is so aware of this, does that diminish its power?
Well, that's my caveat. There's something called the Heisenberg principle, which is that something being observed is going to act differently once people are observing it, either in a laboratory setting as it applies to, I guess, physics or science, but also in the economy. Like if there's this iron law and we're all aware of it, how could it possibly be as effective as it was as an indicator in the past when nobody was looking at it? So I think in the 1970s and 80s or 1970s, late 1990s, you've had these yield curve inversions that nobody was paying attention to. Now we look back, we've mined the data, we've picked up that, wow, this signal's incredible, it always gets it right. So now, of course, we're doing videos on YouTube about yield curve inversions. Right. That was not the case the last 5 or 6 times they inverted. So maybe it's not as powerful, and that applies to everything in investing.
So here's 2 examples of that. Anytime the CAPE ratio got over 30, the market crashed.
Yeah.
CAPE has been over 30 for, I guess, a few years now.
Right.
And then anytime the yield on stocks came down to the yield on bonds, it was a market top. That stopped working in the 50s when everybody was talking about it. So
right.
This seems a little bit more significant because it's like an economic thing.
Yeah, this isn't necessarily about price. This is more about what it augurs for the overall economy.
Yeah, so I would say that this is, I would be hesitant to dismiss this, certainly.
So I was saying before, like as a joke, but kind of not as a joke. Like if it actually happens, I'll take credit for it. But I was saying like the most 2018 thing that could happen is a yield curve inversion followed immediately by 1,000 upside points in the Dow.
Yeah.
Because that is exactly what every market participant says would not happen.
Remember in December 2015, I think the first time the Fed raised rates, the Dow rallied like 300 points. Because, of course.
And then we all switched our narrative. We went from the Fed is trapped, it can't raise rates, then it does, and the market rallies, and the reason is, see, the Fed just showed it could raise rates.
Well, yeah, no, rates are rising for the right reasons.
Or rates are up for the right reasons. Okay, so I don't know that we'll invert in the yield curve. Obviously, nobody does. The bond market is huge. It's highly liquid. It's deep. It's wide. There are like 100 million different players in that market, all doing things for different reasons. But one possibility is that it inverts, and then immediately there's a counter trend move far away from that inversion, and it's almost more like a test than an actual event. So let's say how will we know in real time? We won't.
Let's say that it inverts for a week, and then it never inverts again. It comes, it normalizes a little bit.
Then we say, look, it bounced off inversion or something. You're saying
it bounced off the 200-day moving inversion average.
I mean, it's just, right. It's just like you won't know in real time how meaningful it is, but you do know that the media is going to lead a panic
all over it.
Like it's going to be front page news for the Journal. The Times will probably do something. All the TV channels.
USA Today might. Like it's going to be mainstream, I think.
Like I'll be in TV segments about this.
Totally.
And people will have the range of reactions. People will be like, too soon to tell. Maybe me. We'll have people saying, this is it. I told you so.
Cautiously optimistic into 2019.
And a lot of people saying, yeah, it matters, but it doesn't matter that much because you still have time. Like there's going to be every reaction. I'm going to panic anyway, just like in advance. So I'm going to start now. What about you?
No.
You going to stay cool?
Yep.
Love that shirt.
Thank you. I think this might be your shirt.
No, it's not, but it really sets off your eye. I just want to dive into those blue eyes of yours.
I took this out of the closet.
All right. Fair enough. Listen, maybe panic, I guess, is the message, right?
Yeah.
Go ahead and smash that like button if you like this video. Subscribe to us. Make sure you never miss an update on the compound, and we will be back soon.